If you live in Canada, you've probably heard this 100 times. Max your TFSA, it's a no-brainer. Then in the next video, someone was day trading options in their TFSA, turning 10 grand into $1 million on paper, and claiming all of this was tax-free forever. On the other side, you've got individuals using their TFSA as if it were a checking account, putting in $500 one month and pulling out $400 the next month. And then they're left wondering why their room looks wrong on CRA's website. So what is the TFSA actually? What can you safely do inside of it? And what would quietly get you into trouble with CRA? That's what we're going to break down in today's video. We're going to cover what a TFSA actually is and what it isn't. We'll look at the 2025 and 2026 TFSA limits. We'll see how contributions, withdrawals, and room restoration really work. What happens if you overcontribute and why the CRA charges 1% per month on the excess? What happens to your TFSA if you move outside of Canada? What are the tax traps around prohibited investments and why some TFSA tricks can actually backfire? Why aggressive day trading in a TFSA can turn tax-free into fully taxable? How TFSA withdrawals interact with government benefits like GICs and OAS. We'll also look at a few simple playbooks for how you can actually use your TFSA at different stages of life. And then finally, some spousal and estate planning angles using the TFSA. Here's a quick intro about myself. I'm Withdrawals, a chartered professional accountant and a chartered financial analyst with over half a decade of Big Four Canadian corporate experience. Please take a moment to now read the disclaimer on your screen. With that out of the way, let's start with what a TFSA really is. The name tax-free savings account is honestly not the best branding. A TFSA is not just a savings account, it's actually a tax-free investment container. And inside that container, you can hold things like high interest savings, GICs, stocks, ETFs, mutual funds, bonds, and a lot more. Here's how all of it works. You do not get a tax deduction when you contribute, so it's not like an RRSP. But once the money is inside, your interest, dividends, and capital gains are not taxed while they grow inside the TFSA, and they are not taxed when you take them out. You can withdraw at any time for any reason. Those withdrawals do not count as your taxable income. So in my opinion, a better name would have been tax-free investment account with flexible access. Used properly, it's actually one of the most powerful tools we have in Canada for our Canadian residents. Now, let's talk about limits and the lifetime room. Each year, you get new TFSA room. For 2025, the TFSA limit was $7,000. For 2026, the limit is again $7,000. If you were 18 or older in 2009 and you had never contributed, by January 1st, 2026, your total lifetime TFSA room adds up to $109,000. Yes, you heard that correct. That is $109,000 you can now shelter inside a tax-free wrapper for the rest of your life. Let that sink in. If you turned 18 later, your room starts from the year you turned 18, but the same annual limits apply. And your TFSA room, it is individual. It is not shared with a spouse. It does not depend on your income, and it does not reset if you move banks or brokerages. The CRA, it tracks your total room across all of your TFSAs. You can see your official TFSA room by logging into CRA My Account portal. Now, let's talk about how contributions, withdrawals, and room restoration really work. There are three moving parts. First, the new room you get each year, for example, $7,000 for 2026. Second, any unused room that carries forward from the previous years. And third, withdrawals you make in the prior calendar year give you that room back on January 1st of the next calendar year. So here's an example to put things into context. Going into 2026, all of us Canadians get the annual contribution limit of $7,000 each. Let's assume you had $10,000 of previously unused TFSA contribution room up to the end of 2025. And let's also assume you withdrew $5,000 from your TFSA in late 2025 for a fancy all-inclusive vacation to the Bahamas during the past Christmas holidays. As of January 1st, 2026, your contribution room for this year is calculated as the sum of $7,000 annual limit for 2026 plus the $10,000 of previously unused TFSA room as at the end of 2025, and the 2025 withdrawals of $5,000, which you now get back as your contribution room starting January 1st, 2026. And this gives you a grand total of $22,000 to contribute this year. So if the math is actually that simple, where do you think people get into trouble with this? The answer is, if you recontribute the $5,000 in the same calendar year without actually having had enough room, you would have overcontributed. And that's where CRA's penalties kick in and trip up people. If you put more into your TFSA than you actually have room for, the CRA charges a 1% per month on the highest excess amount for that month. So if you overcontribute $3,000 over the limit and you left it there, that is $30 per month, $360 per year, just leaking away as a TFSA's tax you are now liable to pay. And the two biggest causes of overcontributions are, 1, recontributing withdrawals in the same year without actually waiting for next January, and 2, people have multiple TFSAs at different banks and brokerages, and if we're not tracking the total contributions, we can trip up on the contribution limit. If the CRA sends you a TFSA excess letter, this is what you need to do. Remove the excess amount and then file a specific TFSA return to calculate and pay that extra tax. The bottom line is, keep a simple running log of your contributions and be very careful about recontributing withdrawals in the same calendar year. Here's another big nuance that a lot of people, including our advanced investors, might get wrong. What happens when you move out of Canada? If you move out of Canada and become a non-resident for tax purposes, your existing TFSA can stay open. It can keep growing tax-free for Canadian tax purposes. However, the growth of your investments may become taxable in your new foreign tax jurisdiction, but your TFSA stops accumulating additional annual contribution room from the first calendar year you remain a non-resident for 12 consecutive months, and it will only start accumulating again in the year you actually reinstate your residency here in Canada. You must not contribute to your TFSA while you are a non-resident. Any contribution you make as a non-resident is hit with a 1% per month tax on the full amount of that non-resident contribution until it is fixed. So if you're living abroad and you push $10,000 into your TFSA while the CRA sees you as a non-resident, that can cost you $100 per month in penalty tax until the situation is corrected and you withdraw your contribution. Withdrawals while non-residents are allowed, and the withdrawal will restore room for the next year, but you should only contribute again after you've re-established Canadian residency, and once the CRA agrees you are a resident again. So the rule is simple. Before you leave Canada, consider topping up your TFSA while you are clearly a tax resident if it fits your overall financial plan. And then once you are a non-resident, do not contribute again until you are firmly back as a Canadian tax resident. The next nuance is prohibited investments and advantage tax. For most people, holding public stocks, ETFs, mutual funds, bonds, and GICs inside TFSA is actually totally fine. The trouble starts when people try to get fancy with things like putting private company shares they control into their TFSA, or lending money from their TFSA to their own corporation, or maybe even setting up structures where business income is deliberately shifted into a TFSA in an artificial way. This is where CRA's rules on non-qualified investments, prohibited investments, and unfair advantages come into play. If you hold a prohibited investment in your TFSA, the CRA can actually charge a tax of 50% of the fair market value of that investment. That is a lot, and it's definitely not worth it. If you receive what the CRA considers an unfair advantage, basically a special benefit engineered to boost your TFSA returns beyond what an ordinary investor would be able to get, they can tax up to 100% of that entire advantage, wiping it out completely. So you do not need to know every clause in the Income Tax Act to avoid being in CRA's bad books. Just use the following practical rule. If you're thinking of putting private shares of a company you control into your TFSA, or maybe you're thinking of related party loans, or maybe some of us saw how I hacked my TFSA scheme on YouTube, just know that is a huge red flag. For 95% of Canadians, sticking to plain vanilla qualified investments inside a TFSA avoids those headaches completely. And closely related to that is the question, Can the CRA tax my TFSA if I'm day trading inside of it? The short answer is yes, in some cases. A TFSA is not a magic shield against all tax no matter what you do. If the CRA decides that you are carrying on a business inside your TFSA, for example, high frequency trading, very short holding periods, using sophisticated strategies and leverage, and basically acting like a dealer or an active trader, they can treat the gains inside the TFSA as business income. Business income is taxable, even if it happens inside a TFSA. The CRA looks at things like how often you trade, how long you hold those positions, how much time and expertise you bring into this, whether this looks more like investing or more like a trading business. They don't give us a nice simple number like 20 trades per month equals business, but the principle is clear. The more your TFSA looks like a professional trading account with constant flipping and very short-term bets, the more you are inviting CRA scrutiny. So if you do plan to day trade your way to tax-free $1 million in your TFSA, please understand this. This is not a zero risk strategy from a tax perspective. If you're just holding a broad ETF portfolio and some long-term stocks, you're unlikely to have any issue there and you're safe. Now, let's talk about TFSAs and government benefits. This is actually extremely important for retirement planning. TFSA withdrawals are not taxable income. That means when the government looks at your income for programs like the Guaranteed Income Supplement, GIS, or the Old Age Security Clawback, TFSA withdrawals do not show up in the income lines that they're testing, but your RRSP and RRF withdrawals do. Non-registered interest and many other sources do as well. So for lower and middle income retirees, and even some of our higher income retirees, trying to avoid or reduce OAS clawback, using the TFSA as a part of your retirement cash flow is actually a huge advantage. You can pull money from your TFSA to supplement your retirement lifestyle without pushing your taxable income up and cutting your government benefits. Over a 20 or a 30-year retirement, that can actually be the difference between keeping and losing tens of thousands of dollars in government benefits. So plan wisely. Let's make all of this concrete with a few quick playbooks for our viewers. Here are some ways you might actually use a TFSA at different stages of your life. The first playbook. Let's imagine you're a young high earner without a house yet. You're in your 20s or early 30s. Your income is climbing, but you don't have any property, and you might want to buy it in the next few years. Your rough order might be max your FHSA if you qualify. That is a great first home account. Then, build your TFSA aggressively with growth-oriented investments, broad equity ETFs, maybe some long-term stocks, because all of that growth is going to be tax-free. Then, as your marginal tax rate rises into the higher brackets, you can start layering in RRSPs for the deduction and long-term deferral, especially if you intend to use a home buyer's plan. The second playbook. Let's think of a mid-career family with mortgage and kids. Now, your life is actually busy and expensive. You have a mortgage, daycare and private school costs, maybe even some car loans or irregular big expenses. Your TFSA becomes your flexible wealth bucket. Part of it is still for long-term growth investments, but a part of it can now be used as a bigger opportunity and buffer fund for things like career pivots, business opportunities, or maybe even major home repairs. Because these withdrawals do not permanently kill the room, you can use the TFSA to absorb those big lump sum shocks without messing up your long-term plan the way a taxable withdrawal from the RRSP account might. And the third playbook is for our pre-retiree or early retirees. You've built up your RRSPs, some non-registered investments, and maybe even corporate funds. Each January, you can now consciously move money from non-registered accounts into your TFSA up to the new annual limit. Over time, this reduces your taxable investment income and it gives you a bigger tax-free pool. In retirement, you should now coordinate RRIF withdrawals, CPP, and OAS to keep your reported taxable income in the target range and then top up from your TFSA when you need more cash without triggering any of those government benefit clawbacks. Let's pivot to two quick angles on spousal and estate planning. First, for the spouses watching. There is actually no official spousal TFSA the way there is a spousal RRSP, but you can give money to your spouse and they can contribute to their TFSA. In a non-registered account, income on that gifted money from your spouse would have attracted taxes on your returns depending on your marginal tax rate. In a TFSA, however, the income and gains inside of your TFSA will compound for your family tax-free. So as a couple, your goal should ideally be to over time max both TFSAs so that you have two buckets working for you and your family. Second, estate. On death, you can name your spouse or common law partner as a successor holder if your province and institution allow it. If they are a successor holder, your TFSA essentially becomes theirs and it continues as a TFSA. You can name your children or a trust as beneficiaries. Beneficiaries receive the TFSA proceeds tax-free, but after your passing, the account itself will stop being a TFSA, and future growth on those investments from the date of death are now taxable in the hands of the beneficiaries in excess of their own TFSA contribution rooms. The main point I'm trying to make here is set your TFSA beneficiary or successor holder designations intentionally and make sure it lines up with your will and your broader estate plan. Let's now recap what we covered in today's video. A TFSA is not just a savings account, it's actually a tax-free investment container with flexible access. For 2025 and 2026, the limit is $7,000 per year, and if you've been eligible since 2009 and never contributed, your total room for 2026 is $109,000. Withdrawals restore room, but only on January 1st of the next calendar year. Recontributing too early is how you get into overcontribution trouble, so avoid it. Overcontributions and non-resident contributions can trigger 1% per month penalties. We also need to avoid these. And let's not get fancy with prohibited investments or engineered TFSA hacks unless you really know the tax rules and you have some professional advice. And if you're running your TFSA as if it were a full-time trading business, please understand that the CRA can tax those gains. TFSA withdrawals don't count as taxable income, which makes TFSAs incredibly valuable for retirement planning, especially if you care about GIS and OAS. As a couple, the long-term goal is often for both of you to max out your TFSAs over time and to set up proper beneficiary or successor holder designations. If you found this video helpful and you want to build a Canadian money system that actually fits your life and brings you closer to your version of the Canadian dream, please hit subscribe, tap like so more Canadians see this, and kindly turn on the notifications so you don't miss the weekly videos every Saturday here at 10 a.m. on this channel. Now I'd love to hear from you. What's one TFSA question you still have after watching this video? Are you more interested in a TFSA versus RRSP strategy, TFSA plus FHSA for a first home, or using TFSA in retirement to manage your benefits and tax? Drop it in the comments below. I'll read those and use them to shape our future videos on this channel. Once again, I'm Yudhvir Gabli, CPA and CFA. Thanks a lot for watching, and I'll see you in the next episode of The Canadian Dream, your Canadian personal finance playbook. Until then, keep learning and keep investing.